In Davos, India is back in flavor. But the big question is, as India and the fortunes for the Indian economy look better and better, the fortunes for the global economy are looking a lot less better. So the big question is, can India do well in an otherwise slowing world economy? Is that possible over a period of time, over the next 5-10 years? To answer that question and many other sort of pressing big questions right now, I've got David Rubenstein. He's one of the biggest names in money management in the world, co-CEO with the Carlyle Group. Mr. Rubenstein, thanks very much for your time.
My pleasure to be here.
Is global deflation the biggest risk out there right now as we start 2015?
Well, I wouldn't say it's the biggest risk. It's a risk, particularly in Europe. But I think Europe, because of actions that the ECB will take, is likely to deal with deflation. And deflation has been a problem in Japan, of course. I wouldn't say that's the biggest global problem. I think the biggest global problem is growth. Growth really can solve a lot of problems. And without better growth around the global economy, I think we will have some economic concerns. I think India has done pretty well recent years. I'd say 4.5% or so last year, projected to grow about 5.5% this year. That's pretty good. China is probably slowing down a bit, probably growing maybe at about 6.5% to 7%, but down from 10%. The United States is actually picking up. It's growing around 3.5%, and that's pretty good for an economy of our size. I think the biggest growth problems, though, really is in Europe, and that's something of concern to everybody. European growth has really been well below 1%.
Okay, let me just tackle this one by one. The U.S., for example, is it really as strong as the numbers suggest? I mean, for example, wage growth has been an issue, although the overall jobs numbers seem to be actually getting better and better.
Well, there's several different issues. The economy is doing well, but the people who are doing well tend to be the wealthier people and the upper income people. So wage growth has not really been very good in the United States, and we do have a greater income inequality than we've had probably since 1929 or 1930. So corporate profits are high, stock market is high, investment deals are doing pretty well, but those in the bottom part of the economy are not doing as well.
So what does it mean? I mean, so what's the takeaway? I mean, for the global economy. So companies will do well, and they've been doing well for the last couple of years. The S&P 500 will do well, but for the global economy, the real economy, what does it mean? What's going on in the US?
Historically, we measure success of economies by growth rates and unemployment rates. We have to learn how to measure them about not just growth rates, unemployment rates, but how people at the bottom of society are doing, and particularly the income inequality numbers and social mobility numbers. So increasingly, when we measure how an economy is doing, we can't just measure GDP growth or unemployment or inflation. We have to measure other things, because that's much more important in the future as we go forward.
And that's actually getting worse, as you were pointing out.
Well, in the United States, income inequality has been as bad as it's been since 1929, 1930. The wealthier are getting wealthier, and the poor are not really advancing. And so that's a problem. But it's true also in other developed markets like Europe.
Sure, in India as well. In the U.S., for example, are markets really bothered with all this stuff, concerned about all this stuff? What's going on, behind the numbers, or they're just looking at the GDP numbers and other big headline numbers?
Well, people look at everything. Right now, the United States has been pretty good in terms of the stock market, and our growth has been pretty good. But as the President said in his State of the Union address recently, we have a lot of problems we have to take care of, particularly those people in the middle class and below who are not doing as well as the people in the upper income categories.
What do you think the Fed is going to do? The consensus is they'll start increasing interest rates sometime in 2015.
A former ambassador to India, John Kenneth Galbraith, once said that the conventional wisdom is almost always wrong. Okay. So the conventional wisdom, I can tell you, is what you suggest, that the interest rates will go up by the Fed in the middle of the year by 25 to 50 basis points. Right. But again, that's the conventional wisdom. I think the Fed is very concerned about not only unemployment being at a low level before they increase interest rates, but also make sure the impact on the currency is not too severe, because the dollar is getting very strong, and we don't want to have too strong a dollar relative to other currencies.
So you're saying there's a chance that they might not start.
Well, I don't want to speak for the Fed, but I would say they're going to look at lots of factors. Nothing is predetermined and nothing is pre-cooked. They will look at the factors every month and make a decision as the numbers come in. But I'd say it's likely they'll increase based on what they've said, but if the economy isn't doing the right thing, that they won't.
You also, in your earlier session here in Davos, you said that every 7 years you get a recession.
Since World War II, yes. Every 7 years in the United States we've had a recession.
And now it's been 7 years since we got the last one.
It's been roughly,
right?
Yes. So, sometimes averages don't always work out, but I would say, while we've had a very slow recovery, and it isn't a typical recovery, and therefore you might say maybe you're going to go longer than 7 years, at some point in the next 2 or 3 years there will be a slowdown. I hope it's longer down the road, but I think it's inevitable there will be some slowdown in GDP growth in the United States, as has been the case in recent history.
Right, and you were referring especially to the United States, right? Specifically
Yes.
with regards to the U.S.
But when the United States has a recession, typically Europe follows not long after.
In Europe, the consensus expectation is the ECB is going to sort of launch its own U.S.-style QE.
ECB is supposed to, on Thursday, announce something. It's unknown what it's going to do, but if it's something like the United States, they'll buy billions of dollars or trillions of dollars worth of debt and other kind of financial fixed income obligations to have the effect of stimulating the economy and getting rid of deflation.
You think it'll work?
Well, it worked in some extent in the United States. We have distorted the economy a little bit by maybe having asset prices be higher than they should be, and having interest rates so low is not probably a good thing for a permanent period of time. But it generally worked because nothing else was really working in the United States. Right now in Europe, there doesn't seem to be any common fiscal policy, so I think this kind of monetary policy is the only thing that Europe has to keep it from sinking into a recession or into a deflationary problem.
But what's your own view, if I were to ask over the next 2 years, 3 years out of Europe? Are we going to see them escaping, slipping into deflation, or you think that's inevitable now?
I think it's likely that the program will be strong enough to keep Europe from going into deflation. I don't know that the growth rate will be what it will be in the United States. Europe is going to have much lower growth than the United States. And remember, Europe is not just one country. It's so many different countries and different economies, so it's not as easy to move it along. But clearly, if you had a common currency, which you do, and you had a common monetary and common fiscal policy, it'd be easier, but Europe doesn't have all that.
What's the lesson one should draw with what's happened with the Swiss National Bank and what they did in terms of abandoning the currency peg and what we've seen in terms of global currency?
Well, one lesson would be when you watch television ads say, go be a currency trader, don't do that. In the United States, there are ads all the time saying it's easy to be a currency trader. A lot of currency traders lost a lot of money. So if you're really an investor in currencies, you really need to know what you're doing and be very careful about putting too much money into any one position.
But what's the bigger lesson?
Well, the bigger lesson is that central banks are going to have to do what makes sense, and they're not going to be able to have artificial limits or floors because in the end they don't work.
So pegs don't work, essentially, right?
Artificial pegs probably don't work, and we saw that 20 years ago with the British pound.
You think it was basically an admission what the Swiss did, well, we can't sort of control this anymore, the cost is too high?
It's an admission that it was being very expensive to do this because they would have to spend a lot of money to support this peg, and so they made a change without really telling the market, so it was unanticipated, and because of that, a lot of people seem to have lost money on it.
China, you said things are slowing down, but it's not disastrous, right?
No, China grew at 10% a year for 30 years in a row. No economy in the world has ever done that before. But now that it's such a big economy, let's say $9 to $10 trillion of GDP, it's hard to grow at 10% a year. Growing at 6.5% to 7% is very good. This year, or 2015, probably they'll grow at maybe 7%. We don't know for certain. Last year was probably around a little bit more than 7%. But it's hard to sustain, 7-8% growth at a big economy. I think China is doing reasonably well. You just have to lower expectations about what China can do.
You think, we'll see more easing there as well? From the central bank there and generally fiscal stimulus?
I don't know exactly what they're likely to do. It depends on the variety of factors. But I'd say right now the Chinese economy is in reasonable shape. Their biggest concerns have been, in recent years, corruption and pollution, and they're addressing those issues.
Are Chinese, assets, equities, for example, a good investment, from your point of view?
Well, we tend to invest in private equity kinds of things, and there's some good bargains in China. We've made a lot of money in China, but China is probably easier to do private equity deals than India.
What about, let's come to India and what's going on here. New government in place, lots of enthusiasm. You can see, the number of sessions we've got around India now, ministers speaking, etc. What do you make of all the enthusiasm?
Well, I hope that the enthusiasm is well warranted, and I hope Mr. Modi is able to follow through on many of the things he's said he would do. I did meet with him when he came to New York at the beginning of his term, and I think there's enthusiasm for him in the United States, as there is in India. But getting things done is always harder than talking about them. But I think so far he's made some very good moves.
What's his biggest challenge, according to you? For him, what's the biggest challenge in terms of getting the economy back in?
Well, the biggest challenge is you've got 1.2 billion people in a very large democracy, and people are not used to having the government tell them what to do and everybody follows in line. It's not quite China, so it's not easy to move this economy, and the history of India is that it moves relatively slowly when there are economic changes at the center. So it won't be easy, but I think a lot of people hope that he succeeds.
In India, for the last many years, the focus has been to control the fiscal deficit. Deficit financing, well, markets won't like it. The rates have been too high. The RBI has cut rates now a little bit. More is expected. Do you think now we're finally getting to a stage, especially in India, that government needs to start spending? I mean, maybe forget about the fiscal deficit for a little while. Otherwise, the cycle is not coming back. I mean, the private sector is looking to the government to start spending before they invest.
Well, the budget cycle is such that now I think for the first half of your fiscal year, you've got a very, very large deficit, probably as large as you were projected to have for the entire year. And so that's a concern. I don't know whether the government can afford to spend much more money, but clearly getting private sector to come in and foreign investors to come in and help with the infrastructure that needs to be built would be a good thing.
When you talk to your peers in money management, industries, etc., what are they telling you about India? I mean, do they want to write the check yet, or they want to wait and see how this is going to pan out?
India has not been a great place for private equity investments over the last couple of years. It's been good, but it's difficult to do deals there because every deal is a non-control deal. In other words, you don't do classic buyouts, and everything is what's called a PIPE. You're buying a stake in a publicly traded company. It's harder to change the companies. And also the stock market has been a problem. But the real problem in recent years has been the devaluation of the rupee against the other currencies. So let's say on the last 10 years, the rupee's gone down about 5% per year against the dollar. And that's been a problem because if you're investing and you're getting a devalued currency, it's not as good a thing. So I think if the currency could not be devalued as much. Now the currency has come up in, let's say, last year or so, yes. And you've got a very good head of the central bank. I'm on the board of the University of Chicago. He comes from the University of Chicago. He's a very talented man, and I think that he's as good as anybody you're going to get to run that position.
The big focus, I mean, which is being pushed here in Davos as well, is Make in India. I mean, that's Mr. Modi's message, right? Come make in India, set up factories, invest, etc. But very broadly, do you think, and there's been a bit of debate between what the government is saying and what Dr. Rajan at the RBI has been saying. Dr. Rajan has argued that to follow China, what they did 30 years back, very weak currency, cheap labor, I mean, that's not going to work anymore. The world has changed. Whereas what the government seems to be doing is, I mean, essentially following what China did. Because, as you said, jobs, right, are a big, and the only industry which can create jobs is manufacturing. Do you think going that way is going to work, or that's irrelevant? We'll have to find a new way.
Well, I think India has been very good in producing services as well for the West, and they're very good at some of those kind of service or industries, and they have very good technology, and some of the technology companies have been very good. So it's not just manufacturing, but it's clear that you can't do just what China did because it's a different country, different set of circumstances. India has to be India, and I think India recognizes it has to make some changes. Today, private equity investment is very interested in being in India. We're interested in putting money into India, but we have to make sure the right opportunities are there, and I think the government could do more to encourage private equity. For example, pension funds and insurance companies in India cannot invest in private equity, so that's not a very good signal. If we don't think private equity is that risky, and other people around the world don't think it's that risky, why shouldn't pension funds and insurance companies be able to invest in private equity in India because to get a good rate of return? But having that local capital go into private equity would help foster a bigger private equity industry. The private equity industry in India, the indigenous private equity industry, is relatively modest compared to what we see in other countries.
So, I mean, these are some of the changes you would expect when the budget is presented later in February?
Well, I'm not sure I expect it, but I hope that at some point there'll be more encouragement of foreign direct investment, more easing of making it possible for private equity to get done in India, and for make it possible for indigenous private equity firms to get built up and to raise money from Indian sources.
If I were to ask you as a private equity investor, very large, I mean one of the largest in the world, which are the sectors you're most excited about as far as India goes?
Well, healthcare is very important. Right. I think financial services is very important. Technology is very important. Those are some that we're quite interested in.
And that's, I mean, you know, infrastructure doesn't figure, and I've asked other big sort of PE giants as well, and infrastructure now doesn't figure. I guess, is that because of the experience we've had for the last couple of years with that sector?
Well, remember, private equity investors are trying to get returns that are somewhere between 15 and 20% net after all fees and expenses. Infrastructure does not yield those kind of rates of return. So when you look at infrastructure investors, they do look at India as being attractive, but I would say it has lots of challenges, and all the money isn't going to come from overseas. The government has to put up some money and partner with overseas investors.
When you said financial services, I mean, are we talking about what kind of companies? I mean, just very broadly.
Well, I think banks are very attractive. We made an investment in HDFC years ago. It was very attractive. So I think banks and other financial institutions, money management firms would be attractive.
Got that. Thanks very much, Mr. Rubenstein. Appreciate your time very much.
My pleasure.
Thank you.